Good morning, everybody. Hope everyone is doing well. Thank you for joining us this morning. Hopefully everyone on the webinar is somewhere warm and sunny. It is rainy and very dreary here in Charlotte. So hopefully everybody's at least seeing some sunshine somewhere. So today, I want to cover our agenda today and tomorrow. We're going to kick off with what I would say is the everybody's favorite and clearly the best industry statutory presenter out there, Connie Jasper Woodruff. We're really excited about that. We're going to hit the statutory accounting and reporting updates, which will include things like statutory statement changes, risk-based capital revisions, general statutory accounting updates, valuation of securities task force, and we're going to hit some NAIC topics, including an update from the most recent November NAIC national meeting. Following Connie today, we're going to bring in a few of our tax leaders who will give us a federal and state tax update. I've not seen this presentation post-election, so not going to comment on how political it could get. So I would just say stay tuned and maybe have popcorn for that session. Should be exciting to hear where we think we're headed with that. Tomorrow, we're going to have 3 sessions. One, we're going to lead off with how AI is shaping the financial services industry. We're going to follow that up with an hour related to the NAIC bond project, and then we're going to close with a GAAP accounting update. Before we get started today, though, I did want to take a couple of minutes and walk through who Forvis Mazars is. And I should probably introduce myself, as I was just so excited to say that we had Connie teed up here. So my name is Matt Church. For those of you that I don't know, I'm the national industry leader for our insurance practice, obviously based in Charlotte, a dreary Charlotte today at least. I've been with some iteration of the firm, which we'll talk about momentarily, since 2000, and serve clients both in assurance and consulting. So to talk a little bit about who Forvis Mazars is today, we have to go back a little bit, right? And that's the BKD and the DHG merger of equals that was announced in 2021 that became effective June 1, 2022. And that's when we became Forvis, and we were super bold. We got, all caps. We went hard and leaned into the red, just kind of an exciting brand, which lasted 18 months. When November 15th, 2023, we announced the creation of the Forvis Mazars network, which became effective June 1st, 2024. So a little bit about Forvis Mazars. We're a top 10 global firm with about $5 billion of combined revenue. We have over 400 offices in 100 countries and over 40,000 combined employees, which is led by more than 1,800 partners. No significant change to the industries that we serve in the U.S. Hopefully those who are clients on the call today have not felt any change in service. Hopefully what it's done is open up some new avenues and potentially some additional resources as it's broadened our bench through the Forvis Mazars formation. Globally, though, however, we are focused on just a handful of industries as we kick things off, which are financial services, which includes our insurance practice, technology and life sciences, manufacturing and distribution, and that also with private equity being sort of the fifth is what I would say global focused industry. No change to how we serve clients, as I said before, in the U.S. We are still, anchored to our unmatched client experience, which has 3 really, what I'd say are core principles, which is listen to understand, be responsive, and consult with purpose to deliver value. And hopefully you've seen that. We continue to stay hyper vigilant on making sure a lot of things have happened. There's been a lot of change to our organizations. But we want to make sure that those distractions are limited to our clients, and then hopefully nobody has felt that. The video kicked off there. The key things are watch for pop-ups for CPE, and do take the survey. It does help us as we think about content for next year, time of year, things like that. any feedback that you can give us is definitely appreciated. So I know I went through that pretty quick. Really just wanted to be able to turn this thing over to Connie. And so without further ado, don't want to hold this up. Connie Jesper Woodruff.
Good morning, everyone. Well, I'm sorry, Matt, that it's so dreary down in Charlotte. We have sunshine here. The problem is it's 25 degrees, so the sunshine doesn't do us a lot of good. Okay. So we're going to spend the next couple of hours, everybody that's here joining us today, looking at statutory reporting and accounting updates, basically for this year end, although a little here and there on what's going on with a few other things, and maybe everything won't be effective right away. And we're going to wrap up the 2-hour session with some tips on how to get ready for your first quarter reporting because of the bond project that has been completed and put in place. Now, we're not going to spend a lot of time on definitions. I believe there's a session tomorrow that's going to go through this whole bond definition and all that detail. What I put together is some tips to help you get ready because it will affect your first quarter reporting. You don't have until year end 2025 to do this. Matt kind of gave you the outline of what we're going to do today. We'll start out with our reporting. Where accounting changes are incorporated into the reporting, I include the SSAP information at that point in time. Okay, so it makes sense to talk about it together. We'll move into risk-based capital. Several updates going with the different formulas there. Then in the statutory accounting section, basically, these are a few items here and there that didn't directly affect reporting format or reporting instructions, but that you should be aware of. We're not going to spend a lot of time on the detail. Plus, I'm going to bring you up to date on what happened in Statutory Accounting Principles Working Group meeting. The national meeting was held in November, and so we'll bring you up to date on what happened there. We'll also do the same thing with the Valuation of Securities Task Force, tell you what they've done this year, plus what happened in the meeting in November that they had. And then we'll wrap it up with that bond update that I was talking about. Okay, so we're going to start with our first poll here today. Okay, this one will get us started. Just a reminder, you're going to have to do several of these polls as we go through here. Of the following topics that are included in today's sessions, which are of the most interest to you? And this kind of helps us pinpoint things in the future and what direction to go to as well. The annual statement updates, risk-based capital updates, the new bond definition and corresponding first quarter reporting, or the Valuation of Securities Task Force activity. Now, as we go through the presentation, if you have any questions that come up, you do have a Q&A box where you can submit those questions. And we're going to be monitoring those questions as they come in and try to get caught up with all of them when we stop for the different polls. So, you know, I encourage everybody, if you have questions, to submit them during the presentation, not wait until the end, because I kind of like to handle those things as we go through here. Okay, great. Well, it looks like everybody's mostly interested in the annual statement updates, which is great to hear because that's what we spend a lot of time on. Okay, but there is some interest in a lot of other things too as we go along. All right, let's take a look at that reporting and accounting update. Now, most of you know that our notes to the financial statements seem to change every year. And in fact, they're getting to be quite a major part of the book. And we got changes for this year as well. So this is note number 5, and this will be all the different statement types will have this in their notes. And note number 5 is the investment note, which is getting quite long. So this is a new part that's being added. It's part S. So we haven't run through the whole alphabet yet on the length of note number 5. And this one has to do with collateral that's being held for collateral loans reported on Schedule BA. Now, last year, Ian, you had to do this kinda. Okay, you did it in the aggregate. You didn't have to provide the detail of what kind of collateral was being held. It just asked for some amounts on collateral loans in the aggregate. This year, however, and going forward until they decide to change it, okay, we're going to look at the different types of underlying collateral for those collateral loans. Now, I do want to put out here right away, many of you probably say, I don't have any collateral loans on Schedule BA. And that may be true at this point in time, okay? But with the new bond definition coming in next year, it's anticipated many companies that haven't had collateral loans will have some that show up on BA. They used to be classified on D, they get moved to BA, and because they have collateral behind them, they'll get classified as a collateral loan once they get to BA. So in anticipation of that, okay, they're putting a lot of things in now that have to do with collateral loans. So this is the note that you'll see this year. Sorry, the print's kind of small on it. Now I've got a couple of them that are circled. Okay, the one line that says loans next year will be entitled Issuer Credit Obligations, or ICOs. Okay, that's one of the new major classification of bonds. And the other one that's circled says Loan-Backed and Structured Securities. That will be changed to Asset-Backed Securities, or ABSs, next year. So just kind of a heads up, it's not going, the disclosure is not going away, but you will see a little bit of change in the terminology. Staying in the notes, the financial statements, every statement has a reinsurance note back there. And we're actually seeing a deletion from the reinsurance note. The disclosure that was required for the Transitional Reinsurance Program and the Risk Corridors Program of the Affordable Care Act, the ACA, is being eliminated because those particular programs within the ACA have been terminated. They were temporary in nature. Okay, they've run out at this point in time, so this disclosure isn't necessary. Now, related to this, okay, the supplemental healthcare exhibit also asks for some information about these programs. And in deleting the note, it was overlooked that that was still in that supplement. So you're still going to see the supplement there, the questions in the supplement, the disclosure back there. Now, interested parties reached out to the NAIC and on this issue because we're saying, well, if for 2024, they don't have to do the note, do they have to do that part of the supplement for 2024? And believe it or not, got an answer back just today when I opened up my email this morning. And the NAIC is saying, yes, go ahead and do that disclosure for 2024 if you have anything to report, because you should still have some of that information or a runoff type situation on it. And then there is already a blanks proposal out there for 2025 to take that away from the supplement. Now, one thing I want to bring up that is not on the slides, last week there was a notice put out for the NAIC on note number 12. Note number 12 is the one that asks about retirement and compensation programs. Last year, they should have deleted, I think it's 12C, but it's the part on the defined benefit plans. It should have been deleted last year, and they didn't get it done. And they didn't get it done right away this year either. But they deleted it just last week by an editorial comment or an editorial exposure that was adopted by blanks. So your instructions, if you buy them from the annuals from the NAIC, may still have that disclosure in there. But this has been posted out on the Blanks website under documents, and then there's a document that has editorial changes listed, and you can take a look at it because you, if you fall under that, you will not have to do that for this year. So I just kind of wanted to bring you up to date on that. Okay, into the general interrogatories. Now, both of these general interrogatories we're going to talk about here currently exist, so we don't have anything new, but the reporting might change a little bit for you. And this first one has to do with the question that asks about investment managers and investment advisors. It's been in there for a while, and companies are supposed to list those. Now, examiners, state regulators have found when they go in and do examinations on the companies that a lot of companies are only listing their very top tier managers or advisors for that. And they want to see the sub-managers and sub-advisors as well. What they're looking for is anyone that has access to your portfolio and can make decisions on what's going to be on that portfolio. They want the sub-managers, even if it has to be approved over their heads, somebody else as well. So this might, for some of you, might expand your disclosure back there a little bit. Doesn't matter if they're internal or external, affiliated or not affiliated. Okay, they want to see those listed out there. Another existing note that we have here is back on 35, and this one's been around for a while, and it has to do with private letter ratings of securities investments, where you can use the PLGI administrative symbol on the end of the NAIC designation. Okay. Again, examiners have found, state examiners, when they go in and take a look at the companies, that not all the companies are adhering to the policies that actually appear in the Investment Analysis Office's manual, called those of us that have been around for a while call it the SBO manual. Not everybody's been adhering to those policies. So what they've done is change the language in the interrogatory to emphasize these are the things that you should take in consideration before you use that PLGI administrative addition to the NAIC designation. Now, I'm not going to go over all of this. They put it in the annual statement instructions. It's also in the manual that I referred to, but there's a couple things I do want to emphasize. The treatment on when you can and cannot do this depends on dates, all right? So that's one thing that is outlined in here. The other thing that I want to make sure you understand, I have highlighted in yellow, because this is it's not new, but it's something that's being emphasized. Those private letter rating submissions have to be for the current reporting year. Now, this general interrogatory does not appear in the quarterly, so we're only talking annual. If you have, let's say, as a company, you submitted the private letter rating, the letter with the private rating on it, let's say in 2022, you submitted it to the SBO, but you haven't submitted one since then it's no longer valid. What they're saying is that letter has to be received every year, current year, for the reporting. And that's one thing that's really being emphasized in this revision that goes out there. So you might want to check that out and see what's going on with that. Now, another thing that came up during the November meeting, and then we've had an update since then, is the private letter rating rationales. The SBO talked to the Evaluation of Securities Task Force and indicated that a lot of the rationales for the letters had not been submitted, and they need to be submitted annually as well. Okay, so the SBO got permission from the regulators on the task force that if the rationales were not in by year end, they would delete those private letter ratings investments from the database. And if they get deleted from the database, that means companies have to start all over again, refiling them. There might be a filing fee that goes with all the documentation that has to go with it. So that's how the NAIC meeting ended. However, the ACLI and a couple of and NASBA and a couple other organizations had talks with the task force afterwards, and they were saying that a lot of the reasons these rationale reports had not been filed is because of system problems at the SBO. They were not able to file these. So they didn't think they should be penalized because of the systems problems. Now, it's my understanding a lot of those system problems have been cleared up, but because it was such a problem in companies getting these rationale reports submitted, they've decided not to delete them at the end of December if they haven't been received. And right now they've got a deadline of January 31st for reevaluation. They're not saying they're going to delete them if they haven't been sent in by the 31st, January 31st, but they want companies to have that as their new target date to have it in by January 31st of 2025. So again, this has been posted out on the Valuation of Securities Task Force website in case you're looking for some backup from that. It was sent out via an email just last week. Okay, and with that, we are ready for another poll as we go through here. This question, the general interrogatory, we question information regarding investment managers, brokers, dealers, and others with authority to make investment decisions include primary and sub-advisors. Is that true or false? Hopefully some of you won't have to increase that list too much for what was going on this year. Don't forget, if you have any questions that come in, get them submitted in the Q&A box, and we will get those taken care of for you. If you have a question, chances are somebody else also has a question. Maybe the same one.
Connie, you're doing a great job. I don't see any questions so far about your material.
Yeah, it's early yet. We haven't got into the other stuff. Okay, great. Everybody, just about everybody got the right answer. All right, the right answer is true on this one. You know, I always wonder, sometimes the right answer is obvious and most people get it, and I always wonder about the 1 or 2 people that go with the wrong answer, if they're just doing it to be able to answer, or if they're doing it to look, to, you know, aggravate me. But it doesn't matter if you have a right or wrong answer, you get the CPE credits anyway. Okay, now we're going to move into Schedule BA. Schedule BA, we're going to do not just a lot of emphasis on collateral loans, but we're going to be spending a lot of time on BA. Period. So I apologize for those of you that might not have a lot of BA assets, but that again has been changing over a period of time and will continue to change. So this is something that should have been taken care of last year, but the NAIC noticed was not. It was kind of overlooked by several the companies. Last year, there was a general statement issued that said all residuals should be reported on Schedule BA. Okay, all of them. And most of the companies got that taken care of as far as residuals that used to be reported as bonds on Schedule D Part 1. But the NAIC, when they reviewed the data, noticed that there were still some items sitting out there that look like common stock or preferred stock, but in substance, they're really residuals. So those should have been moved over as well. So they have emphasized this in the instructions to Schedule BA. And you'll see some residual reporting lines in there for you to use for something along that line. There were revisions to SAP number 30R and 32R, but those actually happened last year, so you should have caught those. So it's just kind of a reminder that all residuals, and we mean all, should actually get moved over to Schedule BA if you haven't done that already.
Connie, could I jump in with a question from the audience? Sure. Are these changes being discussed effective for 2024 annual statement reporting or 2025 annual quarterly statement reporting?
Right now, they're all 2024. If it's something that doesn't go into effect until 2025, I specifically say that. So these are all 2024. Okay. Now, this one didn't result in any format changes, but it does kind of might affect your accounting. So I wanted to bring it up here, and it's SAP number 97 on the valuation of investments in subsidiary control and affiliated entities. So there was some confusion on what had to happen as far as an audit was concerned, where there was a downstream non-insurance holding company. So what they've done is actually deleted the language to take out the confusion. It read like if the downstream non-insurance holding company did not have an audit, that anything it owned in the way had to have an audit too. And that's not exactly what was intended. So it's just been clarified here that if they don't qualify for one of the special audits in SAP number 26, which is basically a SAP audit, okay, then they will have to have audited GAAP financials in order to be an admitted asset. So again, a little bit of a language clarification there to take things forward. SAP number 21, that's our SAP on other other admitted assets, and these are usually where you'll find the accounting guidance for things that go in Schedule BA. All right, this one brings up a uniform measurement method for all residuals, regardless of the legal form. Now this one, okay, officially is not effective till January 1 of 2025, but companies have the option to early adopt it. So I wanted to make sure everybody knew about it during this session in case they wanted to early adopt or they plan on doing that. So during the discussion on how residuals should be valued on Schedule BA, the discussion between regulators and industry didn't go too smooth. Okay, we'll put it that way. So this is one of the few times when companies are actually being given a option of how to value those residuals. The regulators prefer what's under the first bullet, which is the effective yield method with a cap that's been put into it. Now, I didn't go into details. All the details are in SAP 21 on how this is done. Okay, but essentially it's recording things at cost and then doing an amortization on it. So that's kind of it in a nutshell. So that's the way the regulators would like to see it. However, industry pointed out to them that because these residuals being moved over to BA and having new valuation methods, to go back and historically recreate this effective yield method would be very burdensome. Okay, it could be done, but very, very burdensome. So they offered regulators an alternative called the cost recovery method, which regulators decided can be used as a practical expedient. Again, all the details for this is in SAP 21 as well. It also has some limitations, so neither one of them are wide open, on the valuation for this. So again, companies can early adopt this for 2024 and moving forward, or they can wait till the first quarter of 2025 and put it in place at that particular time. Okay, sticking with SAP number 21, and we're going to go back to collateral loans here for a little bit. They have kind of beefed up the instructions on, or the qualifications on when a collateral loan reported on Schedule BA can be admitted asset. Now, these things I'm going to tell you really aren't new. Many states have had these already written into their regulations or their state statutes. So, but now it's being put into SAP number 21. So the first thing is the fair value of the underlying collateral has to be sufficient to cover the collateral loan. All right. Now, a little word of caution here. The SSAP as revised says it has to be 100% covered. Your state of domicile may have a different requirement. I have worked with a couple of companies that have had collateral loans in the past, and both of those companies were domiciled in 2 different states, and both states required that the fair value of the collateral be 105% of the outstanding debt. So if you're going to end up with collateral loans in Schedule BA over the next 2 or 3 years, you need to make sure you understand what your state of domicile requires in the way of collateral. If the collateral does not cover the outstanding amount, then the part that's not covered has to be not admitted. You don't have to not admit the whole thing. You just have to not admit the part that is not covered. Also, the collateral has to qualify by itself as an admitted asset. If the collateral itself is not an admitted asset, the entire collateral loan becomes not admitted. And this means that if the underlying collateral happens to be like a joint venture, an LLC, a subsidiary control or affiliated entity, those entities to be an admitted asset require an audit. So if those are the collateral, the audit has to be in place, or they become non-admitted, which means the entire collateral loan becomes non-admitted. So again, these are kind of rules that have unofficially been around and are on the state, a lot of the state's books, but now they are in SAP number 21. Something else that I want to bring up here is you'll see some of my slides have the SAP numbers with R's on them and some of them don't. Starting with the Accounting Practices and Procedures Manual in 2025, all the R's are going to disappear off of the names of the SSAPs. R's originally stood for revised, so that if you saw like SAP number 21R, you knew it had been revised from the original origin, all right? But so many of these SSAPs have been revised so many times that the R's really are kind of meaningless at this point in time. So they're taking them off. I've left some of them on the slides, taken some of them off. I say it R sometimes, sometimes not, to get everybody used to the transition that we're going to be having come up. Now, let's move on to this one. Again, we're in all statement types here. And this was decided in August. It's all crypto assets are let me correct that. All directly owned crypto assets are non-admitted assets. Now, earlier, back in 2021, we issued an INT that said all cryptocurrencies, directly owned cryptocurrencies were not admitted. This expands that. It actually nullifies the INT, and it is put into SAP number 20, okay, that all crypto assets are now not admitted. Again, these are directly owned. Now, there's a general interrogatory in the book that does ask you about cryptocurrencies. That one stays. Okay, they didn't take that one out. So you still need to have that in there as well. Now, it doesn't cover indirectly owned crypto assets. And I've had a couple of questions come up with that. So you kind of have to look at the language and make sure you understand what they mean by directly owned crypto assets. Now, this is something that came up, and I got an update from my slide. Even this, my original slide, I had to update, and now this is also had to update because of a memo that was put out by the NAIC last week. So let's explain the problem first, okay? Lloyd's of London deactivated about 200 of their syndicates. And some of you might have had business with those syndicates. When they deactivate them, that takes them off of the NAIC company listing books, and that means they become unauthorized reinsurers. Whereas if they're in the NAIC book, they're authorized reinsurers. So if they're unauthorized reinsurance, then we run into collateral problems, right? Because of the reinsurance penalty, what's called the reinsurance penalty or the provision for reinsurance on the liabilities page. So the NAIC got a hold of Lloyd's to find out what was going on, and they have deactivated these over 200 syndicates. Now, one would hope that they would send out letters to the seeding companies that had given these syndicates business or paid these for it, but evidently that didn't happen because it kind of took industry by surprise. So what Lloyd's has done is out on their website, and I wish I had a link for you, but I don't. Okay, out on their website, they have posted the list of the syndicates that were deactivated. So you need to check to see if your syndicate that you had on your reinsurance reporting, if it's been posted out there or not. And then they not only have they posted the deactivated ones, they have shown what syndicate it was transferred to. Any of their older business. Now, I don't know why they deactivate them, and my impression was they're not taking new business. So if they still have the older businesses on the books, that was all transferred to a different syndicate. That number's out there, and the NAIC says the new syndicate number is the number you are to use for your Schedule F or Schedule S reporting. So that's not what my slide says necessarily, but this is a memo that was put out by Statutory Accounting Principles Working Group. It's on their website under Documents. It's also on the Blanks Working Group website under Documents if you need a copy of it to prove to everybody that you know what you're doing. Okay, we're going to move into some of the specific statements now. We're going to start with the property casualty. The actuarial opinion on the property casualty. This is just kind of a change in procedure. With the P&C companies, every year they were supposed to submit their opining actuaries' qualifications to the board, and every year the board had to approve them. Well, a lot of times opining actuaries don't change every year. It's the same person a lot of times. So now it says you do not have to do that annually. You do not have to put the opining actuaries' qualifications before the board annually. Once they've been approved, it doesn't have to happen again. If you change opining actuaries, then yes, their qualifications have to be submitted to the board and that has to be approved, but then it stays until you have a change of personnel again. Just a reminder too, that we have a new line of business that started with the first quarter of 2024, which is for pet insurance. Now, I know most of you probably don't have pet insurance and you're thinking this doesn't affect me, but double think this for a minute, because you might have work papers like in Excel that are set up to where you can import them into your annual statement software and not have to do all that data entry, right? Well, because it's a new line of business, that means the underwriting and investment exhibit changed, the IEE changed on it. So your spreadsheets that you have may not import correctly if you don't go in and make adjustments for this new line of business. That's why I kind of want to put it out there for everybody. And they also added a whole new section, section U to Schedule P, just for the pet insurance. Okay. Now, speaking of Schedule P, let's do a little bit more on it. This year, for the first time, the printed copies of Schedule P will all go to 10 years. There are no more 2-year lines of information on that. All of them going to 10 years. Okay. So, and that includes the new pet insurance that's going in there. Now, don't panic. All right. Most of the companies already have 10 years worth of information to put in there. You just might not know about it, because if you have one team that works on the annual statement and a different team that works on RBC, then the statement team might be going, oh my gosh, we've got to go back and recreate 10 years, because they're not, that's what they're saying. They went all 10 years this year. You're not going to gradually work into 10 years. Go talk to your RBC people. The RBC people have had worksheets in the formula where they've had to put in 10 years worth of information for all lines of business. So they have that information for you. So it might not be as difficult as you're thinking, but it has to be all 10 years this year, starting with this year. The cybersecurity supplement that the P&C companies have, you're going to see major reformatting changes on it and a new part. Now, here's the deal. They've taken out a lot of the reporting that had to do with, excuse me, identity theft coverage, because regulators have found out that the majority of identity theft coverage is not being offered by insurance companies. It's not insurance companies. So they weren't getting the information they hoped from this supplement. So it's gone. They've eliminated the claims made and occurrence breakdown within the supplement. And they have taken out the interrogatories asking about tail policies. Then they added this new part that you see in front of you, which is Part 5, and it's reporting of certain informations by state. So it is broken out by state. This was actually, I think this is a great way to do it, because the alternative was to create a state page for every state, which is a lot of extra work to do. So we're going to put them all on one page. So if you have cybersecurity coverage, then you're going to want to take a look at this. Remember, the rest of them, the other 4 parts, did some major reformatting on that one. And now we're going to segue into poll number 3. What category of assets do revisions to SAC number 20 indicate crypto assets belong to? Okay, are they admitted assets? Are they short-term assets? Are they not admitted assets, or are they long-term assets? SAC number 20 gives you the indication on that. Got any questions coming in, Jenny?
Quiet as a mouse over here.
Okay, cool. Let's see what everybody says on this one. Okay, our correct answer that we were looking for are non-admitted assets. All right, moving on, we're going to get into the life and fraternal statement here. And we're going to go to note number 21. Now, this is a note that has to do with disclosures for admitting of negative IMR, okay? Companies were supposed to do this note last year, but it wasn't in the software. It was one of those that got added that was supposed to be in your written notes. If you admitted some of the negative IMR, this note should have been completed. And the NAIC says a lot of you admitted the negative IMR, but did not provide this disclosure. Okay, well, they helped you out this year. It's in the software this year. It's going to be data captured, and there's going to be several different parts to it. I'll show you those in a minute. Now, one thing I've been getting questions about is, have they decided if we're going to be allowed to keep on admitting negative IMR? No more decisions been made. It's still in place. I think it's made to go through year-end 2025 before they have to decide again. There's a group working on AVR and IMR, and this is one of the things they're going to be taking a look at. So right now, you can keep doing it, okay? So let's take a real quick look at what that note looks like. There's several different parts. It starts out by just asking for the aggregate negative IMR allocated between the general and the separate accounts. And then the negative IMR that was admitted. Okay, you start out with just the whole thing, then the admitted part that was allocated again between the general accounts and separate accounts. From there, whoops, I hit the wrong button. There we go. From there, they want to see the calculation of your adjusted capital and surplus, because the amount you can admit of the negative IMR is limited to a percentage of the capital and surplus. So they want to see how that calculation was done. The next one there is the percentage, okay, of it that you admitted, the percentage of your capital and surplus that's in there. And I believe there's one more. Oh yeah, and this one is if you have derivatives, okay, would only apply to you. If you have gains or losses that are in the IMR from derivatives, there's information that should go in there too. So this is what should have been done last year. If you didn't do it last year, you get to do it this year on that one.
Connie, can I jump in with 2 questions from attendees?
Sure.
Going back to your slide about Lloyd's of London,
Yeah.
does the change on the Lloyd's reinsurance take place in 2024, affects 2024 Schedule F?
Yes, it does. It's for 2024. It actually, they deactivated them back about the middle of the year, and nobody caught it for a while till it came time for the NAIC to do their listing of companies books again.
Thank you for that. And yes, there is. This is multi-part. Going back to the Lloyd's of London slide, will this list and related requirements be decided before the end of this year for the 2024 annual statement, or is this still being worked through for later reporting dates?
No, the list is out there on the Lloyd's website. Okay, I have not had any indication the NAIC is going to post the list. They posted the memo telling everybody to go to Lloyd's and take a look and see if their business was transferred over to a different syndicate. So that's for this year. Okay, great questions, guys. Let me see. Oh, yeah, I'm going to go to the next slide here because we've got a little bit more on the negative IMR, allocated gains or losses on the derivatives. That's kind of a lengthy one that they put out there. Now, continuing with the idea of the negative IMR, there's a general interrogatory that asks you, if you're admitting negative IMR, have you done everything that's supposed to be done? So it lists everything, all the guidelines that have to be met. So this is an attestation general interrogatory. Okay, you simply answer yes or no to it. Okay, but you're indicating you've done everything the way you're supposed to do it. There is a rather large new general interrogatory that is put in the life statement and life and fraternal statement. This slide plus this slide over here shows you the entire thing. Now, let me tell you what this is going to be used for. In the life risk-based capital formula, the C2 section, a lot of the information that was put in there for the calculation, the resource or where it came from was indicated as company records, a lot of company records. Regulators don't like seeing that in RBC. They like to have direct ties between the annual statement pulled right into the RBC. So this interrogatory that I just showed you, the 2 slides were, this is the company, well, it used to be the company information that was provided for the RBC. You put it into the interrogatory now, and then the software vendors are pulling the information from this interrogatory directly into your RBC. That's the background behind this rather lengthy general interrogatory, but should save you some time when it comes to the RBC. Just a reminder for the life and fraternal companies, last year you got a new state page, well, actually new state pages, And but you didn't have to do all the columns or provide all the information for 2023. You got to defer. Some of it could be deferred till 2024. It's 2024. The deferment is over. You have to do the entire thing as long as it applies to you. Also, the amortization table for the IMR and the ABR has been updated. Okay, this is the link where you can find it out on the NAIC website. And the interest rate on this did go up from 5% to 6% for the amortization. Now, they've been doing a lot of work on IMR and ABR for the life. They got a subgroup that's been working on this. It's a subgroup of the Statutory Accounting Principles Working Group. So gradually over the next few years, you're probably going to see some changes on this. This one's a big one, okay? I cannot emphasize enough for those of you that have gains and losses that are going to go in the IMR, have to make a decision between the IMR and the ABR. Read those instructions carefully. They have changed. There's always been guidelines set up on if this is true, then it goes in the IMR. If it's not true, your gain or loss goes in the ABR. There's been measurement guidelines put out there for all different types of assets. Those have changed, okay? You need to look at them carefully for this year. So where the NAIC designation was used as a time measurement, then that instruction has changed. The big one is on mortgage loans. If you have directly on mortgage loans, the guidelines on that is if there was a valuation allowance established for that particular loan, then the gain or loss goes to the ABR, not the IMR. So these are the types of instructions that have been changed on here. I kind of summarized a few of them here, but you need to read those carefully to make sure you get things categorized correctly going into year end this year. Also on the IMR and the ABR. Now, first of all, disclaimer, I know nobody that's listening to this would ever do this, but there are some companies that have been. Let's say you own ABC bond. And your ABC bond has been rated, has a designation of NAIC 2 ever since you owned it, okay? And so you've been treated, and so if you do any selling of it, the gain or loss would go into the IMR, all right? Now, let's say that you get wind of something happening at ABC and that their credit rating is going to be downgraded because of that. And it's going to be downgraded to the point that if you were to sell it, the IMR or the gain or loss would have to go to the ABR, not the IMR, okay? What companies are doing is they're selling the ABC bond before the credit rating officially drops. And then they keep that gain or loss in the IMR. Of course, they want it in the IMR because it can be amortized, whereas they put it over into the ABR, it's an immediate hit on that end. So, like I said, I know nobody here is doing it, but what this is saying is that the reporting is not necessarily based on the NAIC designation at the time of sale. If you know that's going to drop and you're trying to sell it to get rid of it, you need to treat it as if it had already dropped. And then on the VM20 supplement, okay, this one they've been making changes to just about every year since it's been put in here. You're going to see some more changes in there, and a lot of it has to do with telling you where to put separate accounts, how to report separate accounts in the supplement. So you might want, if you got separate accounts, you might want to re-review the instructions for all that. Health statement. Specific to the health statement, got nothing for you. You get everything like all the investment stuff and general interrogatories and the notes that are shared with everybody, okay, but nothing specific to the health statement at this point in time.
Connie, I have a couple questions for you before you start RBC, if that's okay. The first is, for the negative IMR prior period capital and surplus disclosure, should this be for the previous quarter or annual statement?
Should be for the annual statement is my understanding. I've never had anybody ask you my question. That's good. But I would think it would be for the annual statement.
Thank you. The second question, Can you confirm the cybersecurity insurance coverage topic was for companies who have purchased rather than sell cybersecurity insurance?
No, this is for companies that sell cyber insurance.
Thank you.
Yeah, they offer cyber insurance coverage. Okay, let's move on to our RBC. Now remember, as we go through here, guys, RBC, I'm just trying to emphasize this because of some things that's come up during discussions at the NAIC. RBC calculates the minimum amount of capital and surplus a company should maintain based on its various risk exposures. It's not an optimal amount, okay? It's not an ultimate amount or or even just the main like break-even point. It's a minimum amount of capital and surplus, and you'll see why that's important as we go through here a little bit. So the first change that we have here is on the RBC factors for receivables for securities. This is reviewed like once every 3 years, and usually the factor changes. It did change on all 3 of the statements, but all 3 of the statements have different factors to start with. Now, this usually isn't a big deal for most companies. It's not a substantial change that would really, wreak havoc with your overall RBC factor on that one. For those of you that have health insurance, you have a part in your formula for the underwriting risk for the health insurance. These factors for these particular lines of business that you see here change every year. And the reason for that is when they originally came up with the health factors, they did not include the effect of investment income. So every year they have to go in and change the factors to allow for investment income. What you see in red and underlined here is the actual changes that were made to each one of the tiered factors. Now we're going to move into the specific ones. In the underwriting risk, remember we got pet insurance now as a new line of business, but when it comes to RBC, yeah, it's in there in RBC. There's not enough experience to come up with an industry average factor or a company average factor because nobody's reported it on Schedule P yet. So it's going to be handled with the special liability. If you happen to have the pet insurance, it will get the same factor as the special liability. A lot of the P&C companies that have health stop loss premiums have been reporting them incorrectly. Now, when I say health stop loss premiums, I'm not talking about where you might be purchasing excessive loss premiums for health as reinsurance. As reinsurance. What I'm talking about is you, as a provider of health insurance, provide your providers with stop loss coverage. Okay, and they pay you a premium for that. So this gives you the correct reporting for that on page 19. You might want to double check to see how you've been reporting if this affects you, because a lot of companies have been reporting it twice and have been taking a double hit for it, and that's not really what they're after either. And then every year our industry experience factors change, and this year that was no exception. So I have them here on slides real quick. All I'm going to say is that the yellow indicates an increase in factor, and I put the current year factors, those are highlighted, and then right next to it the previous year's factors. So yellows are increases and teals are decreases. This one is for line 1 on page 17 and 18. Then the next slide, here we go. The next slide is on page 17, lines 4 and 8 had factor changes. Again, increases in yellow, decreases in teal. And the last one here is page 18 on lines 4 and 7. Notice over on the right-hand side on 18, almost everything is in yellow and increased this year for that particular set. Staying with the P&C, you guys have this catastrophe reporting section, which is actually getting to be quite big in the RBC, and we got more stuff being added to it this year. Now, this year, what we're looking at here, guys, is they're being added for information collection only. So the 2 new things that's being put in here will not affect your official RBC results. All right, that's what's to keep in mind here. So they're adding first a new section for severe convective storms And they have issued a preliminary listing. It's out on the out on the property risk-based capital website for the working group. They adopted it at the meeting in November, and what they have adopted is out there. It goes through October of this year, and then in January, they're going to update it for anything that qualifies in November and December. So the storm that you report has to be on the list, not just every severe thunderstorm that happens to come along. Okay. And then they've added a section for what is called climate condition catastrophe exposures. Now, this only applies to the hurricane and the wildfire. Wildfires, by the way, is still only information. It's not official yet. And what they're looking for is, this is a way to, what increased exposure do you have in hurricane and wildfire because of climate change? Okay, I'm still trying to get a handle around the whole idea on this one. It's a really complicated. There's some great instructions in there. Plus, what the NEIC has done is they have created out on their website a climate scenario resource center. And this gives you all kinds of information on how to handle this section of the RBC. So you might want to take a look at that. Now, the NEIC put out some instructions on how to find it, and I couldn't find it using their instructions. So if you go into the NEIC's homepage and search for Climate Scenario Resource Center, then you'll find it, and it'll pop up for you. They also added 3 new interrogatories to this section, asking the company about their catastrophe risk reinsurance programs. Also in the formula, because Schedule P is now going to have all 10 years worth of data for all lines of business, they took those 10-year worksheets out of the formula that was in there. They were never officially part of the submitted formula, but they were worksheets you were supposed to keep. They're taking them out because they can automatically be pulled in from the statement now. Now, for the property, casualty, and health, we had some problems that had to be corrected. So one of them is for both of these statements, Schedule BA reporting for residuals. This year, they pulled out the residuals on the formula and given it its own separate line, which you can see down at the bottom of the box there. They were included with others before, but they brought them out. And the factor is going to stay 20% for the residuals for the P&C and health companies. Okay, that's what it was last year. It's going to stay that way for this year as well. Okay, also for property and for both the P&C and the health, there was a problem on the affiliated worksheet for both of those that has been corrected. And I believe on the next slide, I have a picture of it. Yeah, this is in the excess affiliated stock column, column 13, which would not affect you if your affiliated stock was not publicly traded. This is only where it's publicly traded. Anyway, the clarification they put in for the worksheet is included in that column should be both common and preferred stock. Before, it just kind of sounded like only common stock, so it's supposed to be common and preferred stock. But they also discovered that it was not flowing through the formula correctly anyway in either one of them. So they've had to correct that going forward. On this slide, the PR numbers indicate property risk-based capital page numbers. The XR number indicates the health risk-based capital page number. So what's in red is things that have been corrected. Now on this particular one, they pulled things out, but they made no factor changes on anything. So that's kind of the good news, but it just was not, and this has been this way for years. So like I said, it only really affects companies that have that affiliated or subsidiary stock that's publicly traded. We're not quite done yet with this correction. So we're also bringing it in back where you're looking at coming up with your the actual formula where everything is summarized. It had to create a separate line back there as well. And what, we got one more? No, that takes care of that one. Okay, health RBC. We didn't have any statement-specific changes for you, but we got RBC changes for you, okay? Your healthcare receivables are now going to use a tiered factor approach, and the pharmaceutical rebates are being handled separately from all the other healthcare receivables. So for your pharmaceutical rebates, The first $5 million will have a 20% factor applied, and then anything over the $5 million will get a 3% factor. For the rest of your healthcare receivables, the first $10 million will get a 40% factor charge. Then anything over the $10 million will get an additional, the 5% on that one. So this may substantially affect your RBC outcomes for the health entity. So you may want to take a close look at that and see what goes there. So at this point, we have another poll number 4 for you. What does the result of the RBC formula indicate? The optimal amount of capital and surplus the company should maintain based on the various risk exposures. The minimum amount of capital and surplus the capital should maintain based on its various risk exposures. It doesn't mean anything. Or D, the maximum amount of capital and surplus the company can have based on its various risk exposures. I've used this poll before and some other things and get some interesting answers back on it. Okay. Now, if you think real hard, I gave you the answer to this at the beginning of the RBC section, but not because of the polling question, because of something else that comes up later. All right. So the answer that we were looking for here is B. The minimum amount of capital and surplus should be maintained. And I always like to see how many people think it doesn't mean anything. That's always interesting, right? 2% of you indicated that it doesn't mean anything. So I hope you're not doing the RBC for your company. All right, health RBC, we're going to continue with your formula. There was another mistake that's been in the formula for quite a while, besides that stock one that we had for affiliates, all right? And this one is for the reporting of Medicare and Medicaid. And when it flows through the underwriting risk, I've circled here for you the 2 cells it should flow through, okay? But the actual mistake that had to be corrected is back here on this box, which is what the investment vendors were using to get things pulled into that cell for you, okay? And you can see that they had the instructions were actually wrong for them. So that's been corrected this year. This will only affect you if you have Medicare and Medicaid, and then getting things pulled into the right cell. So with the instructions, this box being corrected, the vendors then will get things pulled in correctly for you. But you may see a little bit of variation from what you're used to in your formula. We'll go to the life formula now, and on this one is an additional line was put in where total adjusted capital is being calculated for non-admitted insurance affiliates. Now you can see from here, it used to appear up on that first line that's under there, which is line number 6. It used to be in there. They pulled it out separately, but the factors stayed the same. So no matter the fact that it's got a separate line now, it should not make a change in your reporting because it's got the same factor as where it had been reported before. Also on Schedule BA, where you have affiliated mortgages classified as residential, all other, those are also being pulled out onto their own separate line because you can use a look-through for this for the life companies for their RBC. This one does have a new factor, however. Companies have kind of been burying them in with some of the other reporting categories for underlying characteristics of mortgage loans. So now it is being pulled out, and it does have the 0.006 factor assigned to it. Okay. There is, for the collateral loan reporting from Schedule BA for the formula, there's new mapping for those that have the underlying characteristics of mortgage loans. So collateral loans, but they have underlying characteristics of mortgage loans. Again, you're going to be allowed to use a look-through, so those are pulled out and put on the separate line to keep them from dropping down into the all other invested assets. Because if they drop down to all other invested assets, the life companies get a 30% charge, By keeping them up here, they get the mortgage loan charge to it, which is considerably less. And unfortunately, not so good news for the life and fraternal companies that might have residuals on BA. Your factor this year is going to 45%. It was 30% last year, 45% this year. Plus, there is that sensitivity test that's built into the formula that adds an additional 10% to that. So be prepared for that if you have residuals and you do the life RBC. Now, a couple of things I want to bring you up to date on what's going on with the RBC. And one of those is some significant revisions to the preamble. And this is where that minimum capital and surplus comes in. You see, there's a lot of things companies are not supposed to use their RBC for. Unfortunately, most of those items were put into the model law that was passed by all the states. So the model law says you can't use it for marketing. You can't use it for a comparison to another company. It's got all kinds of can'ts in it, but it was never really, but companies are doing it when they're not supposed to. So now they're taking that language, it's still in the model that got adopted by your state, but they're also putting it in the instructions. So hopefully you'll read it, because most of you probably don't go back and read the model law. So they're going to put it where you can find it. Then there's a lot of other areas that are being worked on as well. These are all just being considered. There's nothing final on any of them. They are thinking about taking those two numbers from the RBC out of the 5-year historical pages. And actually, industry wants it left in there, last I knew. They're looking at how the covariance calculation works in all the formulas. Does it need to be revised? They've added sections to it throughout the years, but the way the covariance works has never been changed in the formulas, and now it might be by the time they get done with that. And this same group is going to be taking a look at the negative IMR issue that's working on that. But they are forming a new group starting in 2025, the RBC Risk Research Working Group. And one of the things these guys are going to be doing is, in all the formulas, anything in there that has never had a factor change since the inception of the formula, okay, is going to be reviewed to see if it needs factor changes, except the investments. We got a group that already works with investments. So anything that never had a factor change since the time the formula was implemented is going to be reviewed, and we may start seeing some factor changes there as well. Okay, look at this. We got another poll that's in here. Sorry about this, guys, but I have to get a certain amount of polls in within a certain amount of time. So this one, all of the risk-based capital formulas are identical. True or false? I never really said whether they were identical or not, but let's see what you guys know or what you guys think anyway. How we doing on questions, Jenny?
You're all clear for now. Thank you for answering them along the way.
You say it's all clear and I get started, then they turn around and put their questions in. So maybe that's a good reminder.
It's thought-provoking. It just takes us a minute to process. Yeah.
Exactly.
Thank you.
It looks so nice outside, the sun's shining, and it's 28 degrees, so. Okay, the answer is false. That is correct. Even though a few of you thought they were true, okay, they are not. Now, what happened at the NEIC national meeting? Not much in the way of RBC. The capital adequacy, and this is, I've got capital adequacy working group. That's a mistake on my part. It's capital adequacy task force. They did approve those listings for the convective storms and for the catastrophe event listing that they always put out. Those will be updated in January for the last 2 months of the year. Only the property risk-based capital, along with the catastrophe risk working groups met. None of the other ones met. All of them are working on the 2025 formula now, so the 2024 is set. On the property side, they are looking at making wildfire an official part of the formula, but they're just talking yet. We haven't got beyond that. Okay, let's take a look at a few statutory accounting issues. These are just things I want you to know about so you can go back and find out more if you need to. This one goes into effect January 1st of 2025. The revisions mainly are to 93 and 94, but then 34 and 48 had to be updated a little bit. So 93 and 94 are cover the new market tax credits, okay? And these are investments that companies can make in these tax credits. You need to read this carefully because 94 in particular had a lot of revisions to it. What happens here is it actually expands the investments and the types of investments under these tax credits that you can now have as admitted assets. So it may be something that you want to look into in the future going forward. If you haven't done that from the past, then you want to look at this. And the start and year end, for year end 2025, they'll have some new reporting lines in Schedule BA form, but they won't be there for the quarterly yet. That's still outstanding. So we will see some revised categories there. So there's another investment you may want to look into. Whoops, what did I do? Hang on just a second, guys. Did I forget to? Okay, I forgot. I skipped the slide. I'm sorry. Let's do this slide real quick. This one on SAPS number 25 and 63, it addresses transfers of assets for the whether they're modifying an intercompany pooling agreement. Mostly this is P&C companies. If you modify that pooling agreement, there's new rules on this now. And this took 3 years to get put in place. And there are some major changes in here. So you may want to take a look at that. And they added some new disclosures under SAPS 15 and 86. If they want those done for this year, they will put out a memo in December. It hasn't come out yet, to blanks on what notes should be included in the written notes. Then I apologize. This was the slide that I had for the new market tax credits. Okay, on that one, I kind of already talked about that one. Sorry, I had it up, didn't have it up there for you. Next, we're going to go to 21, and these are mainly, what they did is they put a formal definition of residuals in SAP number 21. So the formal definition of what a residual is in 21. Then they had to go back and modify several other SAPs to refer you back to 21 for the residual definition. So minor things in there, except now you know where to find the definition for that. Now, at the meeting in November, this is what SAPWIG did. Okay, this was their hearing agenda. Now, a hearing agenda means these items were previously exposed for comment, and some kind of action was due to be taken on at this meeting, okay? So all of them that you see there in the brackets were adopted, all right? Now, some of them are for 2025, and some of them will go into this year, but if there's any new disclosures for this year, that'll come out in a memo from SAPWIG, 2 blanks indicating what exposures that are not in the software needed to be included in your written notes, okay? So the one 2024-18, that one is on that new tax credit thing. So that one's not till 2025 on that one. And one of them I do want to point out is down here on the 2019-21 and INT 2401. This is a Q&A document the NEIC has put together on the new bond definition. Okay, now they had put it out there for exposure and industry had been working with them on it. There's only 13 items on it right now, but they have said this is not going to be static. This is going to be dynamic. As more questions come up that need to be answered, this document will become lengthier, all right? But what I wanted to point out here is besides the document being out there, and it is on SAPWIG's website, okay, besides the document being out there, they made it an INT. By making it an interpretation or an INT, that puts it on a level 2 of the statutory hierarchy. If they had just left it as a Q&A attached to an SSAP, then it would have fallen down as a level 5. Okay, but by making it an INT, it's a level 2, so it gives you a little more authority when trying to make decisions on how to do these things. The last 2 items on the slide, the one on collateral loan, they re-exposed it. They didn't make any changes to it, but they re-exposed it because the corresponding blank exposure is out there now too for new Schedule BA lines. And if any changes have to be made, they wanted the two to be made at the same time and then adopted. So they're just kind of waiting for that. And the last one on repack and derivative investments, they're going to be rewriting this or actually bifurcating it into two different parts. So right now the whole thing's on hold as we go through that. Now, we're not quite done with them yet. They had a meeting part then, and this is where they usually put out new items for exposure. And that's what's happened here. All these items were put out for exposure. Now, I want to call your attention to a couple of them so that you may want to, you should read all of them. But I do want to call your attention to the first one, restricted asset classification. They are concerned because when they look at reinsurance agreements that are ModCo or have funds withheld, they can't tell what assets on the company's books are restricted because of those. So they are a restricted asset. So they're clarifying these are considered restricted assets. And the proposal right now would be to add a whole new section to both Schedule F for reinsurance on the P&C side and Schedule S for reinsurance on the life, fraternal, and health side, a whole new section that would list these restricted assets because of ModCo contracts and funds withheld contracts. Might want to take a look at that. Investment subsidiary classifications. They're looking at adding disclosures to the statement where if you have an affiliated investment or an investment subsidiary, you would have to list all their underlying investments. Okay, not just list them as a company that you own or as a subsidiary or affiliated with, but you have to list all of their investments. You might want to look at that one. And if you do Medicare Part D, if you go down a little bit on the list, the revisions here are because of the new payment plan that Medicare has come up with on that $2,000 deductible, how it can be spread out over the year. So this is how that would be accounted for on that. So this gives you an idea of things that you want to look at as you go through here in the future, like you got time at year end, right, to worry about the future. Okay, we're going to talk about the valuation of securities task force real quick. Remember the collateralized loans obligations that they talked about last year, the CLOs? They were going to have the modeling all ready for them. So by this year end, they would be modeled for valuation purposes like the RMBSs and the CMBSs are. Well, guess what? They're not ready. Okay, the modeling has not gotten put in place, not been established. So you're supposed to take your CLOs and value them like you always have in the past. Now, this slide kind of takes and tells you what's going to happen once the modeling's in place. So I'm not really going to go over the whole thing, but I do want to emphasize that the modeling the new goal is to have it in place for year end 2025. You will not have it for this year end. You will not have it for the first 3 quarters of 2025. So you'll have to continue with the old methodology that you've been using. Other things that the SBO has done is they have did some clarification to their policies on when companies can self-assign 6 asterisks debt self-designation. By the way, all these revisions, you don't have to wait for the new book to get published at the end of the year, the manual. These are all out on their task force website. They're really good about putting those out there. They changed some of the U.S. government abbreviations they want you to use. For example, if somebody reported something with the VA, does that mean Veterans Administration, or is it down in the munis and means the state of Virginia? So they're trying to eliminate some of those. And also in 2025, they're going to have less spacing available where these abbreviations are used. So they had to make some adjustments there as well, and to try to eliminate these duplications as we go through here. They added Spain to the list of foreign jurisdictions eligible for netting considerations for your derivatives on Schedule DB. So the second bullet point we're going to talk about a little bit later. They had to add some new language on cash equivalents and cash as far as NAIC designations because of some changes to SAP number 2. This last bullet point is interesting. Not that it's not all interesting, but it's interesting. This gives the SVO and the SSG, this is Structured Securities Group, in 2026, gives them the power to challenge any FE designation a company has reported on an investment. So if you report something like a 3FE, they have the right to go in and review, ask how you came up with that, ask for documentation, review the whole thing and see if they agree or disagree, and they have the power to override your designation that you've put out there. Now, they haven't come up with a real policy on how this is going to work yet. They just adopted the language. So we're not sure if the SVO is going to be doing the review or if they're going to hire an outside third party to do review, because there's another paper out there through the Financial Conditions E-Committee asking for comments on that exact topic, how they should proceed with this. But it will happen. It's supposed to happen in 2026, and it will give the SVO some power that they've not had before. So let's do a poll about the SVO at this point in time. Why did the Security Valuations Office, or the SVO, update the abbreviations to be used for the reporting of U.S. government agency and U.S. obligations? A, to eliminate duplications. B, because of new 2025 space limitations for reporting. C, several states are no longer part of the U.S. government. Or D, A and B. I'll be interested to see how many people decide to actually switch these abbreviations on that. Sometimes little things, little changes like this are the ones that don't get picked up. Now, your investment software vendors will probably pick it up for you. So that's good going forward that way. But if you don't use one of them, use one of your own, then this is something you should be aware of anyway. Okay, well, the answer we were looking for here is D. Okay, and that is both A and B incorrect. I'm always interested to see how many people choose C. Several states are no longer part of the U.S. government. 2% of you did that. So it's interesting because I know they do that for effect, not because they really believe it. Okay, let's talk about what the task force did at the national meeting. They did adopt 3 different items here. The first one, the adoption here will require annual reviews of any regulatory transactions that companies are reporting. These are special transactions, okay, so they'll have to be annually reviewed. They did some, they say they updated the credit rating provider listing, the CRP listing, but they really didn't update the listing. It's still the same. What they did is there were a couple of dates that needed to be updated in it, but what they did do is put in some language to emphasize not all CRPs are created equally, that each CRP is only approved to provide ratings for certain investments. So you can't use a CRP for ABC bond or let's say municipal, if that CRP wasn't approved by the SVO for municipal bond ratings. Okay, so some of them are very big, generous field that you can use them for, and others are quite specific. Some of the other CRPs are quite specific on when you can use their ratings. So this kind of emphasized that and changed some of the language, not just with the CRPs, but a couple other places in the book as well. Earlier this year, they had done some work in removing references to the subscript S that used to be used and references to the investment risk, and they missed a few, is what it comes down to. So they went back and did some more work on that one as we go through the whole thing. All right, before I start in on the bond project, and remind everybody here that if you have questions, to get them submitted in here, and we'll try to get those answered. And this bond project section is liable to bring up a few more questions, I realize, but we'll take a look at this as we go through. Keep that in mind as we go through here. Now, again, I want to emphasize, you do not have until year end 2025 to make these reclassifications, okay? You don't. It will affect your first quarter reporting. So think about how it's going to affect your first quarter reporting. First of all, it could affect your assets page, because under the new bond definition, there might be bonds, or what you have reported as bonds on Schedule D Part 1 in the past, that no longer qualify as bonds. And you'll have to move them to Schedule BA. That affects your balance sheet. They come off of the bond lines on the assets page and go down into other invested assets. Now, I want to put to rest a lot of panic that I've kind of heard out there. It's settling down some, so I'm hoping people are getting a better handle on this whole thing. Early on the bond project earlier this year, there were a lot of companies that were under the impression there was going to be a lot of movement off of Schedule D Part 1 and into Schedule BA, because what they had there would no longer qualify as a bond. The NAIC says no. Okay. The NAIC says they are not expecting a mass migration off of D into BA. For the small companies, probably none at all. Can't say for sure, depends on the company. Medium-sized companies, yeah, maybe. The larger companies are the ones that are probably going to get hit the hardest, but even then, they're not expecting a mass migration for the industry. But each company is going to show a little bit different results, okay? So the larger companies, who usually, not always, usually have a little riskier investment profile, do more investing in these types of things that are no longer going to be considered bonds and be moved over to BA than the small and medium-sized companies do. If you're a small company and you're only invested in U.S. Treasuries, you are home safe. You can go home and sleep and not have to worry about reclassifications at all. And even in some of the munis, you're probably pretty well set, okay? So it is not something that will affect every company, except every company has to look at every investment they have and make that determination, except if you've got U.S. Treasuries. Okay, you're home free on that one, guys, okay? So there is some work that has to be done, even though it may mean you don't move anything, it stays there. But there are other places in the quarterly that are also going to be effective. For example, on Schedule BA and D, I know the inventory listings are not there, but the acquisition schedules and disposal schedules are there. And they're going to have all new line categories, reporting categories, line numbers, all new. You have to have so at year end 2024, if you dispose of any of your assets off of D or BA, you have them, and you put them on the disposal schedule for the quarterly, they're going to be in the new classifications, not the old Schedule D or BA 2024 classifications or subclassifications, the new classifications. So there's a change. Schedule D Part 1B has a new format. We will look at that one as we go through here. Schedule DL uses all new reporting categories for the bond parts. That's securities lending. So for any security lending bonds, you'll have all those new line numbers that are in there as well. Schedule E Part 2, that's for the cash equivalents. They will also have new bond reporting line numbers, but there is also a new definition of what can now be classified as a cash equivalent or a short-term investment. We don't have to do detailed listing of short-term, even on disposals for DA, so I didn't include them on here, but it applies to them by the time you get to the annual. So, okay. On this new definition, there's no grandfathering, okay? Everything that's in your portfolio at year end 2024 has to be analyzed and reclassified. Now, you may not have to reclassify them off of D into BA, but you're going to have to reclassify them into the two main categories of bonds, plus the subcategories that are used for reporting. And we'll take a look at those as we go through here. Okay, so you start with year end 2024 and go forward. Now, some of your investment vendors have already started working on this for you. In fact, some of them took your year-end 2023 portfolios and started reclassifying them and then adjusting according to what you disposed of during the year and acquired during the year. So a lot of them have come down to a very workable start, but that's not complete for everybody. And we'll talk more about that a little bit later too. You're supposed to make your best effort at redetermination. The NAIC realizes you might not get it all right the first time, but you should make your best effort to do that. The basis for determining these is supposed to be the date of origin. That's whenever the investment was originated, not necessarily when you bought it. Okay, but then industries come back and said, well, we didn't buy it right away. We don't have all the information to be able to go back to the date of origin to determine if at that point in time it was a bond or not a bond, or if it was an issuer credit obligation or an asset back. In that case, if you can't go back, then the NAIC says to use the information at the date of your company's acquisition. Okay. You use any of the current information anytime you can't come up with historical information. What the good news is, guys, once you do this analysis, once you have determined that something is a bond, you do not have to reevaluate it every year. Once you get it in there, 1/1/2020, the first quarter 2025, you decide what's a bond and what's not a bond, then you don't go back and redetermine all the time, unless you get questioned by your auditors or you get questioned by the state. And in that case, you don't necessarily have to go back and reevaluate. You start out with providing your documentation of how you came up with the decision in the first place. Okay, so that's what they're going to ask for. And then if they don't agree with what you've done, then you may have to do a reevaluation working with your auditors or working with the state to take another look at it. Now, that doesn't mean if you discovered you made a mistake, you can't you reclassify it and get the mistake corrected. Yes, that definitely can happen. But what they're saying is here is you don't have to do this individual assessment every year. Once it's a bond, it's a bond. Even if there's an OTTI, it does not change the fact that it's a bond. You'll handle the OTTI just like the SSAP 26 or 43 tells you to handle for a bond, but it stays a bond. Okay, so not a yearly activity that has to be done. Now, let's concentrate on the first quarter. This is my recommendation. You don't have to do it this way. And I know some of the investment vendors, like I said, have already started to help you with this, but chances are the investment vendors can't do it entirely because they don't have all the documents they need for some of the investments. All right, they just don't have it. You should have it as being the company that's investing in it, but they may be asking you for information. If your software vendor's asking you for information on specific assets, that means they can't do the reclassification. They need your help. But here's what I suggest the order should kind of be. You start with your 2024 Schedule D Part 1, and you review and analyze every security that's reported in it. Okay, every investment that you've got reported there. And make sure they all still qualify as a bond. That's the first step. Do these still qualify as a bond? If not, get them off of D into BA. I'll tell you how to do that later. Then once you've determined these are still bonds, then you have to put them into the categories. Issuer credit obligations, or ICOs. Now in your annual next year, the ICOs will be reported on Schedule D, Part 1, Section 1. We're going to have 2 sections to D1 next year. And so if you classify them as an asset-backed security, then those, and the annual will go in Schedule D, Part 1, Section 2. But you have to make that determination right at year end. Okay, you're going to see that you need it for D1B too. So once you get them as a bond, then you get them as to whether they are an asset-backed security or an ICO. Now, what are we talking about on these? Okay, ICOs are issuer obligations. They don't have anything backing them up except the issuing company's promise to pay. That's it. Their credit rating, their good credit standing, their promise to pay, that's what it is. Okay. And they're covered under SAP number 26. The full definition of a bond is included in SAP number 26. The rest of the SSAPs refer you to SSAP 26 for the definition of a bond. Okay, so that's where you'll find the full definition. Now, SAP number 43 are asset-backed securities. Now, I want you to think about this title for a minute. It used to be loan-backed and structured securities. Now it's asset-backed securities. What did that do? That widened the group of bonds that go into this reporting category. It's asset-backed is one thing, loans are one thing, structures are one thing. So this has increased what goes in under 43. Now, as far as revisions to SAP number 26, 26 has very few revisions in it other than getting the definition in there. So most of the accounting for the ICOs has stayed the same. 43 has practically been rewritten. Okay, you need to look at 43 very carefully on your accounting for these asset-backed securities. So please, please take a look at that very carefully. Now, asset-backed securities are usually issued by an SPV, a special purpose vehicle, but just because it was issued by an SPV does not automatically mean it's an asset-backed security. Okay, you have to do the research. And it might be an asset-backed security without being issued by an SPV. So the SPV really doesn't mean anything when you go through here. Okay, so the focus of these investments should be on the structure, what is actually happening, the structure, not the naming convention, not the legal form. Okay, first it has to meet the definition of a security. That definition comes from GAAP. You can find it as a footnote to the definition of a bond in SAP number 26. So first it has to be a security, then you determine if it's a bond, qualifies as a bond. Okay, so there's certain things that have to be met when it's a bond. There has to be a creditor relationship. That doesn't matter if it's an ICO or an ABS, there has to be a creditor relationship. We'll talk about that more in a minute, okay? There has to be, if it gets classified as an asset-backed security, there has to be a substantive credit enhancement. And within the ABS category, they have to be divided between those backed by financial assets and those backed by non-financial assets. And to qualify for a non-financial asset, there has to be meaningful cash flows. So those are the three big things to look at. This is a this is a chart that has been put out. I think the NAIC has it on their website, that tells you the kind of questions you should ask in just determining if there's a creditor relationship. Okay, so that's the first step after you've decided that it's still a bond, the creditor relationship. Now, the creditor relationship in substance. So virtually what it means here is there has to be bond-like cash flows, okay, with a schedule for one or more future payments. There's a predetermined principal and interest payments with contractual amounts that don't vary because of the underlying collateral. They can have variable interest rates on them, but they can't vary because of the underlying collateral value or other non-debt variable. It excludes anything backed by equity, equity-like characteristics. Those aren't bonds. Okay, so technically, if you have a group of funds that have been collateralized or brought together and reissued as a fixed income instrument, technically those aren't bonds anymore, although there's a way around that for some of them, okay? And just because something has an NAIC designation in the SBO database does not automatically mean it's a bond, okay? Because life companies, for their ABR and their risk-based capital, get to use a look-through for certain securities. And to do that, they get to file them with the SBO to get an NAIC designation. which the NEIC publishes in their database, but they are not bonds. They are stuff that gets reported on Schedule BA with the underlying characteristics of fixed income. So just because there's a designation in the database does not mean, okay, that it is a bond automatically. This is what the Schedule D Part 1B looks like in your schedule, in the quarterly. Okay, you can see it's been divided. Instead of just one line for bonds and one line or a section for bonds and a section for preferred stocks, we've got a section for the issuer credit obligations, a separate section for the asset-backed securities. Now, for the first quarter, okay, reporting, there's a prior year column in there. And so they have some special instructions out there for that, that the book adjusted carrying value at 12/31 prior year should equal the beginning book adjusted carrying value for the current quarter. So they did something a little special in there on that. So again, you'll have to kind of get your 2024 stuff reclassified as you go into this. These are the reporting categories that you're going to be using in the ICOs. You'll need them for your acquisitions and disposals, okay, on Schedule D, Parts 3 and 4 in your annual statement, quarterly statement. Now, if you look at these real quick, you'll see a lot of these are very familiar, and a few of them aren't. These are all defined in the general investment schedules instructions. So we've got definitions for all of these out there, okay? And for many of these, you'll see at the end of the description in parentheses, it says affiliated/unaffiliated. That means you have separate reporting for affiliated investments in that category from unaffiliated investments in that category. So separate sets of line numbers for all of these, okay? Now, one thing that's kind of nice, the SAP number 26 always had some things listed in there that got reported as bonds, even though technically they weren't, and those all stayed. So you still get to report those SVO identified bond ETFs as a bond, okay? Bank loans still get to be reported as bonds. Mortgage loans that have been qualified as credit tenant loans, okay, those get to stay in there. And your long-term certificates of deposits get to stay in there as well. In addition to that, not technically bonds, but get to be put in there. This one was also still in there in SAP number 26. And these are some of the registered closed-end funds. So those are still going, those that used to be in there still are going to be in there as well. So that part didn't change. That's kind of the good news on that one. Now, once you've decided it's a bond and you've got the ICOs out of the way, the issuer credit obligations, then we look at the ABSs. Okay, all ABSs have to have a substantive credit enhancement. What does that mean? Okay, a substantive credit enhancement means that the investor, you as the investor, have to be in a better financial position than if you owned those things that are underlying collateral directly. So in other words, there has to be a guarantee put in. There has to be over collateralization, something that makes it safer, if you will, for you to invest in that asset-backed security than if you were investing in the individual collateral itself. That's what's in there. Once you get it classified as an asset-backed security, you have to determine if it's a financial asset-backed security or a non-financial. And I'm finding some companies are having some difficulty with that. Now, when it comes to a financial asset, that's defined in SAP number 103. That definition's been in there for a long time, has not changed. And any non-financial asset, besides having the substantive credit enhancement, also has to have meaningful cash flows to be classified in there. These are our reporting categories that we have for the ABSs. Never seen these before, guys. Okay, these are all new. So we have liquidating, self-liquidating, meaning they have principal payments that come in over time, principal and interest, and by the end of the maturity date, they're gone. They have self-liquidated. Then we have not self-liquidating. We have those down in the that use a practical expedient versus a full analysis, and that's in determining meaningful cash flows. Okay, so this is all more stuff that you'll learn about. I think we have a session tomorrow that covers all this, and so just a lot of detail that has to be gone into for that. So right now, let's do a poll. Okay, this will be poll number 7. When will the new bond accounting and reporting become effective? Year-end 2024, year-end 2025, January 1, 2025, or January 1, 2026?
Connie, as you suspected, there are some questions rolling in on this topic.
Okay.
And you might have answered these in a previous slide, but I just wanted to double check. First question, are there descriptions available anywhere for the new collateral types for ABSs?
I don't think so, because the collateral types that they have to be listing in there are all things like, like different types of bonds or mortgage loans, or they list them out. They're kind of things we're already used to. So I don't remember seeing anything at this point.
Okay, thank you for that. Is there any NAIC guidance on whether companies need to disclose the impact of the bond project in the 2024 annual statement?
Not in the 2024, but we will talk about it for first quarter 2025.
Okay, great. Going back just a little bit, I'll let you wrap up the polling question too. I'm sorry.
Okay, the answer we were looking here is C, in January 1, 2025. So what other questions do you have?
How should these reclassifications be reported on the D and BA verification between years?
We'll talk about that in a minute too.
Okay.
Okay.
2 more. Going back to the Lloyd's of London changes, what do you mean by subject to collateral requirements when reported as an reported as an authorized reinsurer?
No, if they're unauthorized, if they transferred you, well, if you have the old number and you use it, they become unauthorized, and then you're subject to collateral. If they've transferred it to a new syndicate and the syndicate's on the NAIC listing, then they're authorized and you don't have to use collateral. So when the syndicates are not in the listing that the NAIC puts out in their book, then they're automatically considered unauthorized, and we're trying to keep that from happening. Well, hopefully the transfer all went to the new syndicates that are all authorized. Then you won't have to worry about the collateral.
Thank you. And final question. Do all bond ETFs on the SVO approved list get classified as ICOs, or could some end up classified as ABS bonds?
Okay, so what type of, these were SVO approved ETFs, is that correct?
Yes, all bond ETFs on the SVO approved list.
Okay, the SVO has a couple of different approved lists for ETFs, and one of them is a bond listing. And my understanding is if it's on the bond listing, it does get reported as ICOs. That's one of the givens. But there are also some exchange traded funds like for preferred stocks that also are out there. Those would not. Only the bond ETFs that are on the approved list would be treated as ICOs.
Thank you. That's the last question.
Okay, let's see if we can get through this wrap up. I've said this enough. I think everybody knows if it's not a bond, it goes on Schedule BA. Okay, so here's what you do to get things off of D onto BA. All right, there'll be no gain or loss on the transfer. What happens is if you've got something on D that needs to come off and it has an unrealized adjustment, in other words, it's a bond that has to be valued at the lower of book or market, you first unbook the unrealized adjustment. That brings it back to amortized cost. The transfer is going to happen at amortized cost. So then you take it off of Schedule D, you dispose of it at amortized cost, and you acquire it on Schedule BA at amortized cost. Okay? Then once you get it to BA, you may have to value it at the lower of book and market again. Then you'll do an unrealized adjustment to get it down to where it needs to be. Okay, so if you do it this way, you take it off of D and put it onto BA and you flow it through the right schedules on your annual statements, your verification works. If you don't do it this way, your verification won't work. Okay, so that's why I was saying you do it this way. And this is the way that the NAIC says that you're supposed to do it. So you may rebook that unrealized adjustment that you did to transfer it. You may have to take it again once you get it over to BA. Depends on how that type of asset has to be booked. Also, in the first quarter only, you do have to do a note disclosure about transferring off of D into BA. Now, the NAIC has said, do not put it in note number 2. That's accounting changes. They don't want it there. Okay, put it in note 21. They're suggesting 21C. You will not find this note in your quarterly software. It is not going to be data captured. You have to put it in your quarterly written notes. And it only has to go in the first quarter. Okay, you don't have to put it in there the rest of the way. And this slide tells you what amounts they want to see. They haven't even given us a set format for it. They just said, in your disclosure, put this stuff in here. Okay, put this information in here. So you will put it in there for the first quarter. Like I said, don't look for it in your software. It won't be there. Now, let's say you don't have anything to transfer. All right. I suggest you still put this note back in 21 and you specifically say, I did not have anything to transfer, because otherwise they're liable to think you forgot or you overlooked it or you didn't do it. So that's what I suggest doing. That's up to you. That's just my suggestion. Now, just a couple other things in the quarterly here. There's no changes to the verification in the way the quarterly. You'll see some changes to verification in the annual. You know the LEI column, the legal entity identifier column? It's coming off all the investment schedules, all of them, quarterly and annual. It's gone. But because it's gone, they rearranged some of the electronic columns back there. So watch for that a little bit. And we got new reporting categories that will show up on BA for things. We've got, like we said, 3 and 4, we got new reporting categories. Oh, the foreign column off of D and D, they moved it to an electronic only column. So it's still there, they just moved it. DL, they got the new reporting categories, okay, and they've renamed one of the columns. What I want to talk to you about in particular is this, Schedule E Part 2, Schedule D, and Schedule DA, short-term investments and cash equivalents. There is a new definition. Now, this starts in 2025, guys, first quarter. Don't worry about it for this year end. But here's the deal. As cash equivalents or short-term investments, this is a list of things you cannot include anymore. Asset-backed securities. Anything that if it was long-term as a bond would be classified as asset-backed securities cannot be reported as cash equivalents or short-term. You have to report them as long-term. Okay. Any investment that if it was long-term would get reported on Schedule BA cannot be classified as cash equivalents or short-term investments. All mortgage loans, except the credit tenant loans, all mortgage loans cannot be reported as cash equivalents or short-term. Derivatives, that's not new. It's been that way for a long time. Cannot be classified either way. Investments in parent, subs, and affiliates cannot be classified as cash equivalents or short-term investments. And this one's not new either, but those investments that you have been reporting on E2 as cash equivalents or DA as short-term, they have you roll over the maturity date each time. Those aren't supposed to be reported there either. You can't just roll over the maturity date. The whole investment has to be rewritten. If the whole investment gets rewritten, you can keep them on cash equivalents or short-term. But if you're just rolling the maturity date, they get reported as long-term over on D1. So this is important. This is some big changes back on cash equivalents and short-term. So real quick here, I want to, okay, let's get you. I'm sorry, I should have had that slide up for you and I didn't. It's on the slide, so everything says, you can also find it in SAP number 2 revised. These are all the major bonds that have been, SSAPs that have been revised because of the bond project and where you can find the information that you're looking for. The QA document that they have out there right now, these are the topics that are covered on it. It is posted on SAPWIG's website under documents, so that's the good news on that one. Compliance, I've already kind of said this, is your guys' responsibility, not your investment software vendor's responsibility, although it's a team effort, okay, when it comes right down through it. Just because something has an SVO designation does not determine whether it's a bond or not. Now, what I want to let you know, this is very important here. The NEIC has education out there for you on the bond definition at this first website, okay? It's free through year end. Then they're going to start charging for it. There's 7 sections to it. It's pretty good on it, but you get to print everything that's in it so that you can keep it for later use. I was disappointed in myself. I've been attending all these meetings. I thought I'd get 100 on it. I only got a 93. Okay, so anyway, take advantage of that because you can print off this material. And the last website that we have down there, okay, that is where you can find all the stuff that has to do with the bond transition, all the new SSAPs, all the new blanks that have been adopted so that you don't have to go searching through NEIC minutes to try to find them. We have one more poll. Don't go anywhere, guys. We've got one more poll that needs to be done here to make our poll number 8. Which of the following do you feel you need more information on? I did that sentence. It's a bad sentence structure. I know that. I'm really bad about ending sentences with prepositions. Do you feel like you still need more information on annual statement instructions, on the RBC updates, the new bond definition, or none of the above? You feel pretty good about what we went through today, and you've got a lot of information, and maybe know where to go for resources to get more information that you need. Tell us what you think here. Okay, so there's no right or wrong answer here. Looks like maybe the annual statement and the bond definition people still aren't feeling real good with. I understand that. But a lot of you feel like that we did really well today, so that makes me feel good too. Okay, that's all I got for you. This is my contact information. Thanks, everyone.